Right now, something big is happening in the US economy, and most people don't fully realize how close we are to a turning point. Some experts are calling 2026 a year of opportunity, while others are quietly warning about pressure building beneath the surface. Inflation is cooling but not gone. Interest rates are paused but not safe, and American consumers are still spending, even though their savings are shrinking. The real question is not whether the US economy is strong or weak, but how long this balance can last. Today on the US Report, we're breaking down what's actually happening in the US economy. This week, in 2026, what it means for jobs, money, and markets, and why the next few months could decide the direction of the entire year. Before we go deeper, if you want clear, honest, and easy to understand updates on the US economy without the noise, make sure you hit like and subscribe to the US Report right now. It really helps the channel grow, and it keeps you ahead of the curve. All right, let's get into it. As we move through early 2026, the U.S. economy is showing something rare: resilience with tension underneath. On the surface, growth looks solid. Businesses are still investing, consumers are still spending, and unemployment remains relatively low. Many economists now expect the U.S. economy to grow close to 3% this year, which is strong by historical standards. That growth is being powered largely by consumer demand, technology investment, and especially artificial intelligence, which is quietly reshaping productivity across industries. From finance to healthcare to logistics, AI spending is no longer hype. It's real money moving through the economy. But here's the catch. Strong growth is happening at the same time as tight financial conditions. Interest rates are still high compared to the past decade, and borrowing is expensive for households and businesses. Credit card balances are rising, auto loans are stretching longer, and mortgage activity remains slow. This tells us that people are still spending, but they're doing it with more pressure than before. The economy is moving forward, but it's not relaxed. It's holding its breath. Inflation is another key piece of this story. The worst of inflation is clearly behind us, but it hasn't disappeared. Prices are rising more slowly, yet they are still rising. Core inflation remains above the Federal Reserve's long-term target, which means everyday essentials like housing, insurance, and services are still expensive. For many Americans, wages have gone up, but not enough to fully restore purchasing power. That's why confidence feels mixed. The data says things are okay, but the lived experience still feels tight. This is where the Federal Reserve comes in. Right now, the Fed is essentially paused. After aggressive rate hikes in previous years and a shift towards stabilization, policymakers are waiting. They're watching inflation closely, watching the labor market, and trying not to break the economy while keeping prices under control. Rate cuts are being discussed, but they are not guaranteed, and they are likely to be slow and cautious. The Fed knows that cutting too early could reignite inflation, while waiting too long could slow growth sharply. It's a delicate balance. And 2026 may be the year where every decision matters more than usual. Meanwhile, the job market is sending mixed signals. On one hand, unemployment remains relatively low and layoffs are not widespread. On the other hand, hiring has slowed, job openings are fewer, and workers are staying put instead of switching jobs. This tells us employers are cautious. They're not panicking, but they're not expanding aggressively either. Wage growth is cooling, which helps inflation, but it also limits how much consumers can keep spending without taking on more debt. And yet, Americans are still spending. Retail sales remain solid, especially in services like travel, entertainment, and dining. This suggests that people are choosing experiences even as they cut back elsewhere. Savings built during earlier years are being slowly drained, and that trend cannot continue forever. If spending slows suddenly, growth could drop faster than expected. For now, though, consumer behavior is acting like a bridge holding the economy together. Financial markets are reflecting this uncertainty. Stock markets have been volatile, swinging between optimism and fear. On good days, investors focus on strong earnings, AI growth, and stable consumers. On bad days, they worry about interest rates staying high, global tensions, and policy risks. The market is not crashing, but it's not calm either. It's reacting quickly to every new signal, which tells us confidence is fragile. Global factors are also playing a role. Trade policy uncertainty, geopolitical tensions, and energy demand continue to influence the U.S. economy. Energy infrastructure is under pressure, especially during extreme weather, and global supply chains are still adjusting to a more fragmented world. The U.S. remains stronger than many other economies, but it is not immune to global shocks. So, what does all this mean for the rest of 2026? The most likely path is slower but steady growth. Not a boom, not a crash, but a careful walk forward. However, that path depends on three things staying in balance: inflation continuing to cool, consumers continuing to spend without breaking, and the Fed avoiding major policy mistakes. If one of those pillars weakens, the story could change quickly. For everyday Americans, this means planning carefully. Jobs are relatively safe, but not guaranteed. Credit is expensive, so debt management matters more than ever. For businesses, efficiency and technology will separate winners from losers. For investors, patience and risk management are key because volatility is not going away soon. This is why following economic updates matters. The headlines often focus on extremes, but the real story is in the details and the trends. At the US report, our goal is to cut through the noise and explain what actually matters so you can understand the direction before it becomes obvious to everyone else. As we move closer to the end of this video, here's the big takeaway. The US economy in 2026 is not weak, but it is not comfortable. It's strong enough to keep moving, but sensitive enough that small changes can have big effects. That makes this year one of the most important economic chapters of the decade. Now I want to hear from you. Do you think the US economy will grow stronger as 2026 continues, or do you see warning signs ahead? Drop your thoughts in the comments because your perspective helps shape future episodes of the US report. And if you found this breakdown helpful, share this video with someone who wants to understand what's really happening behind the headlines. Thanks for watching, and I'll see you in the next update.